All right, this is the review for problem 11-1A, which is the last problem in chapter 11 homework. I am going to reopen up chapter 11 homework for you so that we can get there, and chapter 12. So that'll be open. It'll be open through Thursday evening. So we're going to walk through this problem here. This correlates to one in the book, which is 11-1A, PR 11-1A. And so that is on page 533. So what we're going to do is calculate the dividends here. Now, one of the things to remember on this, in the preferred dividend, I believe this is a cumulative problem. So in the cumulative problem, what that basically means is that each time we're supposed to pay them. If we do not pay them their dividends, therefore we have to pay it the next year. And that's called arrears. And then we have to pay it the next year if we don't. So we have to continue to, they get theirs before the common dividends get theirs. So that's one thing you want to remember as we look at this problem here. All right, so total dividends here. Let's walk through it. So the total dividends, it tells us that we have 20,000. On this spreadsheet here, if I type in a number that is incorrect, so I'll put 15,000 just to mess with it, there's a star that pops up right here. It tells me it's wrong. So you guys can take a look at that. I will blow this up a little bigger so everybody can see it a little better, especially those online. So if you put it in there, you'll see a little star that's wrong. Obviously that's 20,000 should be, so put the correct number in there. All right, so that means the total that I have to give out is 20,000 for my preferred dividends. That goes all to them. Now, what are they supposed to get each year? So let's take a look here. They're supposed to get, let's see here, $30 par, 1% cumulative stock. So what they're supposed to get, there's 100,000 shares of that. So 1% of that is 30 cents. I take that 30 cents times the 100,000 shares. So that means $30,000 we're supposed to get each time. So
1% is not simply to
yeah.
like math out,
Yeah.
but when they add like a 4 or like 5%, it just, I don't know if this is new, but it just needs to change the whole.
It changes a little bit there, but just multiply it times the par. So taking towards the par, so like this one says $30 par. I take 1% of that, which is 30 cents. If it was 2%, that'd be 60 cents, 3%, 90 cents, excuse me. So I'm gonna take that, so I have 30 cents. We're gonna multiply that times how many shares we have, which is 100,000. So that gives me $30,000 that we will pay. So I don't have 30,000, I only have 20. So that means that they are gonna get all of it. So I take this $20,000 here, and the per share, how much they get per share, there's 100,000 shares. So they're gonna get 20 cents per share, because it's the 20,000 divided by the 100,000. So I'll put that calculation in here, divided by 100,000. It tells me it's 20 cents. I have nothing left over for the common stock. They get 0. All right, for the next part here, 2012, we have 36,000 to give out. So I have 36,000. Well, remember I owe 10,000. Plus I owe 30,000 I'm supposed to pay this year. So that's a total of 40,000. I'm a little short, so I'm going to take all this and go into here. And then I will figure out how much that is per share. And these guys get nothing once again. Now remember, I'm short $4,000. So remember that in our heads that we are short that. Now I calculated that this year because the 36,000 divided by the 100,000. I just did that in my head really fast. Pretty simple math. It's easy. The next year here we have $70,000. All right. So I have 70,000. Therefore, I have enough to pay my 30,000 that I'm supposed to pay that year. Plus I still owe 4,000. So I have enough to pay both of those. So I'm going to take that and put my 34,000 in here, get my per share. The rest of the 70,000 goes to my common dividend. So I have 34,000 going to them. So 34,000, again, makes it really easy for me to calculate the per share. It's simple. And then I have 36,000, which is the remainder. And they get, how many shares do they have in common stock? We haven't had a look at that yet. 400,000. So I take 36,000. Let's take this number here, divided by 100,000. And it's 9 cents. So as we look at this here, we have 100,000 shares here. That's what we calculate off here. And we have 400,000 shares here. So everything, this number is always divided by 400,000. We calculate this, and this is always divided by 100,000. We calculate this. All right. So let's take a look and do the last 3 years. So the next year we have 90,000. So 90,000. They get their normal 30,000. We know they're supposed to get 30 cents. The rest of the 60,000 here. And that's 15 cents. All I do is copy the formula down. So 15 cents per share. So if I own 5 shares, I get 75 cents. And here, it'll be a little different if I own more now. So. All right, so let's look at 2015. So in 2015, I have 102,000 that we have. And we get the full 30 again. That's 30 cents. And that means they have 72,000. And that's 18 cents. And then the final year is 150,000. 30,000 go here. Oops. Hold on. 120,000. As you can see, they got a lot better as a part of that. So I'm going to total these up. I'm just going to add these to Excel. So that's 72 cents and 180. All right, questions there at all? All right, so the annual average annual dividend, we got to figure out what that's going to be here. So to figure the average annual dividend is this divided by 6, because we have 6 years. This divided by 6. So this should come out to be 30 cents. So we're supposed to be anyways, and we're not in arrears. Does that make sense? So that should be 30 cents because we divided that by 6. And this here is 12 cents. 72 divided by 6 is 12. So that's what we will have these two here, and I'll put the calculations into Excel. Calculate that for us. Hold on, a little more. All right, so 12 cents and then 30 cents there. All right, so now we're going to figure out our what we're basically getting for our stock price. So here our stock price is $37.50 for preferred. So it tells us that in the book. And then our common stock is 30. And all we're going to do is this divided by this. They tell us that in the calculation here. So that's 0.8%, a little less than 1%. And this one's 0.4%. Questions? Okay. Not too bad, but you walk through it and just,
Yeah.
okay.
You might get things.
This will be out there in the video, so
Okay.
we should be able to record or rewind that, what you need there. All right, let's take a look at the next problem we're going to look at is 12-1, PR 12-1A here. All right. So this is in your book. So this is basically a calculation of what should we do, how does it affect our earnings if we do several different methods here. So we're going to walk through this and figure out our incomes. This should stay the same. This is where it's going to start to change here, bond interest and those type of things. Remember, interest we can take off of our, we can write that off so we can have a decrease when we pay in taxes. So that's some of the benefits of that. The problem is that it throws off some other ratios as a part of that, like our debt ratios. So that's where it throws off some things, but it may help our earnings per share. We'll talk a little bit about that. If we give out more shares, that messes with our EPS, which is our earnings per share. So those are some things we're going to take a look at here and how it affects our earnings. problem. It's on page 578 in your book. It tells us that they have financing plans of 18 million that they need to consider as a part of that, and looking at restructuring that in several different ways. So these are what companies do as a part of that, how we finance how they're doing. For improvements, different things like that to grow the company. So they look at different ways. And sometimes they want to have a balance as a part of that because we don't want to have so much debt that we're paying on that all the time. And if we continue to get debt, we may have to pay more in interest rates because then we're more of a concern. And that can be more of a problem. We may not be able to get debt later on as a part of that. So some companies will do some balancing as a part of that. But we also don't want to affect the shareholders as a part of that by just issuing tons of stock out there as a part of that to get that. Because that dilutes our value of our shares. All right, so it tells us on the one, says determine the earnings per share of common stock for each plan, assuming that the income before interest is 2.1 million. So this is going to be 2.1 million for each of these plans here. So I'm just going to copy these for each of these, and we're just going to walk through each step here. So in plan 1, it tells us that we don't have any bond. Plan 2, we don't have a bond, but in plan 3, we do. So here we have a $9 million bond. So we're going to deduct the interest expense here. So our interest on the bond is, we have a $9 million bond. We multiply that by the interest rate, which is 8%. So we'll have about 720,000. That is right. 720,000 it is. All right. All right, so our income before income tax here is less. So we're not going to get taxed as part of that, right? Instead, I think we were in the 40% tax bracket to make it easy for us. So I think it said we're in the 40. So what we're going to do is take 40% of this, 40% of this, 40% of that. As you can see, my income tax will be less here. So it's part of that. And that means my net income will be less. And so that's the other things that we have to take a look at there too, is how does it affect our net income as a part of that? But one of the good things is it does help the tax as a part of that. So debt financing does help us in that way. Let me double check, make sure it is 40%. Okay. It's 4. All right, so I went through pretty fast there. Let me just kind of review what I just did. So, actually, let me blow this up and make sure we can see that. So again, this is our income tax. So my income tax here, 840,000, 840,000 because we didn't have the bond interest. This is a lot less because that we're not going to pay as much in taxes. So in here, my net income is this minus my taxes. Is my net income. And so here again, so my net income is higher in both of these areas as a part of that. Now when we calculate EPS, the calculation is this. It's earnings per share, which is EPS, is net income minus preferred dividends over your common shares outstanding. So that's what we're going to take a look at as one calculation for each of these here. So I figured out my net income. Now I'm going to figure out what my preferred dividends are, because we're going to have some dividends issued as a part of that. And so we're going to take that out of there. And then we will figure out how many shares we have within each of these because we issued out shares each time. Let's walk through that. All right, so we have dividends on preferred stock. As you can see in Plan 1, we don't have any dividends at all because we don't have any preferred stock. So that's 0. The next one, we have $900,000. So this is where it gets $9 million, excuse me. So this is where it gets a little confusing here, because we then got to figure out how much that is going to be. So in our calculations here, and I'll put this in the spreadsheet, we have we got to figure out how many shares we have of that. So, how many shares do we have of this? If you calculate that, we take the 9 million that we have, divided by the par. So if we divide that by the par, all right, so that gives me 450,000. No, I know that's not right. I'm going to put that in there. So now I'm going to put the last part of that equation in there. So it's 450,000 shares that we have. Everybody follow me okay on that? So that's how many shares we have. So now let's calculate how much they're going to get per share. So we're going to take 4%, because it says 4% there of the $20. So 4% of the $20 means 4% times 20, which is 80 cents. So I'm going to take that number I have in those shares times the 80 cents. So I'm going to multiply this by 0.8, and that gives me 360,000, and that gives me the correct answer. I don't have that starting point. So basically, you're taking the 4% there that you have times the 20, that gives me how much it is, and then I multiply it by how many shares we have out there. That was the complicated part.
That's what I missed.
Okay. So let me follow up and do the next one here. So this one here, we have 450,000. So similar to this one here, except this is going to be 450,000, or 4.5 million, sorry. That was excluding zero. I like as much money. All right, so that gives me 180,000 there. Again, that's 80 cents per share, but they only have half the amount of shares there because they only have 450,000. So we have to issue 225,000 shares. All right, so the next part asks us for earnings available for common stock. So my earnings is this minus this. So I'm just going to copy those across there. Oops. 648,000 for the last one there. All right, so I've calculated how many shares we have. We're going to calculate how many shares we have out there. So in the common stock, it says that we have 18 million. All of it was in there, $10 par. So I divided by 10 to get how many shares we have. So that's 1.8 million. On the next one, it tells us that we have 9 million shares. Divide that by 10, gives us 1,000 shares. And the last one gives us 4.5 million. Divide that by 10, and that gives us 450,000. And to calculate the EPS, I take that and divide it by the amount of shares that we have as part of that. So we have the earnings divided by the shares. There's the shares there, so $1.44. So this looks better for Plan 3, at least for the EPS side of that. Okay? Now, it does change though when we don't make as much money. So what I'm going to do here is I'm going to take this information and then I'm going to copy and paste it and put it below and change that number on top, because that's the B part of this problem. So instead of making what we thought they made was 2.1 million, they made half that. So I'm going to take all of that, paste it right in here. Let's do that. Okay, we'll do it this way. Over it. Let's put it up here. All right, so now everything's good there. Now as we can see, the difference here, remember Plan 3 was the best? Now if we make a lot less money, Plan 3 doesn't look very good at all. This looks better over here, at least EPS-wise. So it depends, we have to also look at things not just on what would be the best plan, but how our earnings are going to be as a part of that. So we have to look at a lot of different things, aspects when we make these decisions, financial decisions for the company. So same deal, we went through, the only thing that changed was they made half the money that they thought. On interest, you can see, really reduced that. It means in taxes, we only paid $132,000 versus paying here $420,000. And then we still have our preferred dividends, preferred stock, and we also had, these are the earnings that we had available. Not much here, $18,000. Very good. And then those are 450,000 shares, they get 4 cents. Questions on that? I know I went through that pretty quickly there. But. All right, the last part of the question says discuss the advantages and disadvantages of each plan. That kind of goes into those things depending on what you make as a part of that. You can just discuss that. That won't be, I don't think it really requires that to engage too much as a part of that. So, but just kind of knowing how to do that. Any questions on that at all? We'll hit the pause button real quick and see if you have any other questions.